Right. Okay, let's begin. Thank you, everybody, for joining. My name is Greg Goodall, and I'm joined by Priyank Shah. We'll take a minute just to introduce ourselves, and then we'll get started. We've got lots to cover in only 30 minutes in today's webinar on the regulatory reporting calendar and key themes for 2026. Welcome. Okay, so Priyank Shah is a senior implementation specialist here at Suade, integrating regulatory reporting software for clients across liquidity, COREP, FINREP, and MLAR. He previously spent 7 years at the Bank of England in banking supervision and stress testing, focusing on capital analysis and data aggregation. In addition to previous experiences in credit risk management at Bank of America and Citigroup, Priyank holds a master's in electrical and electronic engineering from Imperial College London. Priyank.
Thanks, Greg. So, Greg Goodall is a former bank-side risk and regulatory reporting expert. Greg has worked in various roles across regulatory reporting teams, implementing changes for credit risk, market risk, and financial reporting in the UK, Europe, and US. He's previously worked at Morgan Stanley, JP Morgan, Bank of America, and Wells Fargo in London before joining Suade. Currently at Suade, he leads implementations in Europe. So 2026 marks a pivotal year for UK regulatory reporting, where policy meets practical delivery. You'll need to plan and execute in this final preparation window before the 1st of Jan 2027 deadline for Basel 3.1 implementation. And navigating critical parallel runs in the second half of the year that will test your systems and data infrastructure. The convergence of multiple regulatory streams, Basel 3.1, the smarter regulatory framework, and the EOE's transforming data collection program demands a strategic approach focused on 3 priorities. The first one, building robust data lineage and automated validation frameworks. Secondly, preparing for more granular COREP and FINREP submissions with stricter reconciliation requirements. And thirdly, leveraging Q1 and Q2 2026 for foundational work on data governance and system readiness. Firms that treat this as a data transformation opportunity rather than just a compliance exercise will be best positioned for the Jan 2027 regulatory reset. So, Greg, why is 2026, 2027 such a critical period for UK financial services?
Priyank, so we are seeing a lot of major change and convergence of a number of changes, regulatory changes. As you've mentioned, Basel 3.1 final implementation. There's also changes in the crypto assets regime, enhancements to operational resilience, and remuneration reforms. So this does represent one of the most significant regulatory changes, arguably, since post-2008 reforms. And it's definitely worth mentioning these are not just changes for the big banks. Basel 3.1 impacts every institution from tier 1 banks to smaller building societies. The PRA has now confirmed Basel 3.1 goes live on the 1st of Jan 27. So that makes this year very important in final prep and testing for that go live. You can expect the final PRA reporting templates and updated taxonomies in mid-2026, and these will shape that reporting process. There will also be adjustments to the leverage ratio, aligning to capital definitions and exposure measures. And we can also see changes in the UK's smarter regulatory framework that will introduce further measures reshaping prudential reporting and data collection. The replacement of retained EU financial services law with a more tailored UK-specific framework aims to make regulations simpler, more proportionate, and data-driven, while maintaining financial stability and consumer protection. There is a clear shift towards a timelier, higher quality return. The Bank of England is calling for shorter turnaround times and robust audit trails.
And how does these updates change how banks build and validate their returns?
So, Priyank, the shift from sort of template population to a more world of data provisioning, banks must map more granular data points to the regulatory taxonomy instead of just populating cells on a return. Validations should also move further upstream, embedded in data pipelines, and be the responsibility of data owners rather than an end of process check once the returns have been populated. The PRA expects automated reconciliations between related returns, for example, COREP and FINREP, with audit trails explaining these variances. They're looking for a build once and configure for multiple outputs.
Okay. And would you say there is a clear trend emerging between policy reform and data requirements?
I think so, Priyank. Granularity and integration. Each reform, Basel 3.1, operational resilience, and transforming data, demands more detailed data with clearer lineage. PRA is moving from trust but verify to continuous monitoring via data. I guess a use case for this is that a single economic event should flow through all the affected returns automatically. Policy complexity is now driving data sophistication. Firms should not try and rely on manual report validation. Architecture must allow for automation and the removal of manual reconciliations. Okay, I just want to go through section 2. So the PRA's, so Priyank, I'm going to raise some questions to you now. PRA's Basel 3.1 program and leverage ratio developments. Can we dig a bit deeper into these, please? What is actually changing in practice for reporting, Priyank?
Yeah, sure. So as we know, the 3.1 framework introduces significant revisions for credit and operational risk reporting under COREP. So I'll talk about that first. So if we look at like the C07 template, for example, new exposure subclasses have been added, like regulatory residential real estate, regulatory commercial real estate. Some lines of it, like the SME and infrastructure supporting factor, have been moved to minimum rate and the overall requirement unchanged. There is more granularity in the risk weights now to accommodate a greater risk-sensitive approach for unrated corporate institutions, especially between investment grade, non-investment grade, unrated corporate SMEs. And there's also the outlook for floor calculations, which change some of the old fund templates. There's a new revised template for operational risk, 16. So this is the new standardized measurement approach for operational risk, which replaces all of the current models, including internal ones. Looking at some of the leverage ratios, the new exposure definitions will impact 47 to 48. Off-balance sheet items, which is also in season 7, because of the changes in the credit conversion factors, the removal of the 0% and the addition of the 10% for unconditionally cancelable commitments. There'll be some changes over there as well. And then derivatives, standardized approach for counterparty credit risk becomes mandatory. Chooses financial transactions. There's greater enhanced transparency on collateral. So UK firms need to build parallel run and reconciliation capabilities ahead of the 2027 go live. So the PRA expecting Q3 and Q4 2026 shadow submissions. Dual reporting is the current Basel 3 versus the 3.1 outputs. The reconciliation pack explaining variances in RWA, capital ratios, and leverage ratios, and also testing on IT systems, data flows, calculation engines before go live. Overall, the core expectation is there should be full data traceability and ability to explain movements between Basel 3.1, leverage, and legacy capital calculations. Firms should also use 2026 to test integrated reporting flows and governance between risk and finance.
Thanks, Priyank. Just to follow up on that, do you see banks tying Basel 3.1 builds into their broader data and reporting transformation, or are these still going to be handled in silos?
That's a good question, Greg. So what we're seeing is a bit of a mixed picture. So tier one banks are increasingly towards integrated operations. So Basel 3.1 is acting more as a catalyst for broader data modernization. Many of them are investing in unified risk data platforms that support capital management, and there are other activities like stress testing, regulatory reporting. And they see it more as a strategic approach, so one where the architecture that addresses multiple changes. Some of the mid-tier banks, they're still siloed. So Basel 3.1 will be treated as a compliance project owned by this capital team, separate from finance transformation or reporting optimization. So we see that they will likely meet the deadline, but they may miss out on some of the efficiency gains that some of the tier one banks can capture. And the smaller banks, it's a bit of a mixed picture here. Some strong and simple cloud migration and reporting upgrades, but others making minimal changes to the existing processes. So I think one of the reality checks with firms running parallel calculations will discover data gaps that force broader upstream fixes as well.
Thank you. Cheers.
Thanks, Greg. So pass it back to you on a bit more about the UK Smarter Regulation Programme. How does the strong and simple framework like ES 426 help small institutions in local way?
Thanks, Priyank. Another big change coming, which we can see. So simplified prudential regime for small domestic deposit takers, or SDDTs. The PRA's proportionality approach recognizes that firms with assets under £20 billion that may have simpler business models should not face the same complexity as large internationally active banks. The new regime delivers material relief in three key areas. The first one is capital requirements. There are simplified calculations, removal of advanced modeling obligations, standardized approaches with fewer risk-weighted categories, and simplified credit risk treatment. And there is also reduced complexity for Pillar 3 and streamlined Pillar 2 processes. The second of these, the second of these relief measures is reporting frequency. So there is a lower burden. Core prudential returns required quarterly or semi-annually rather than on a monthly basis. The elimination of certain granular templates, for example, detailed FINREP schedules. So this enables the banks to focus on material risks, reporting which is tailored to the firm's size and its risk profile. And then the third form of relief is in the liquidity requirements. This is a more streamlined framework, simplified LCR and NSFR calculations, reduced stress testing obligations, and greater operational ease, fewer data points and less frequent liquidity reporting. So why does this matter? Proportionality in practice is basically what the PRA is saying. It aligns regulatory expectations with firm size and complexity, frees up resources for core risk management and for customer service. The regulatory intent is to support competition and diversity in the UK banking sector without compromising on resilience. So the bottom line here is that SDDTs will benefit from lower compliance costs, simpler processes, and clearer expectations, while maintaining prudential soundness. So they're not adding any risk to the system here. Firms should review eligibility and update internal policies and prepare or revised templates and timelines. Okay, so here, Priyanka, I'm just going to add a word in about eligibility. So the firms that are eligible should let the PRA know by March of this year. These firms are those which have assets under or equal to 20 billion pounds, an average which is over 36 months. They should have a domestic focus, at least 85% of exposures in the UK on average, or a minimum 75% at all times. They should have limited trading activity, trading book of less than or equal to 44 million pounds, and 5% of total assets or less. Their FX positions should be 2% or less of own funds, and they should have no commodity positions. The other restrictions include no clearing, settlement, custody, or payment system operations, and should not have a non-UK parent. So this is a very much a UK-centric piece of legislation. There is a strategic point here. Some banks on the cusp, some mid-tier banks, may restructure in order to qualify as an STDT. And as I mentioned, firms wishing to opt into the STDT regime must notify the PRA by the 31st of March 2026 to benefit for go live. Additionally, the Bank of England's transforming data collection program continues targeting more consistent data sets across templates and firms. Bank of England applying successful insurer model to banks, replace duplicative returns with unified data warehouses. Submit once and reuse, essentially. The banking pilot starts in 2026. In Q2, consultation on integrated frameworks, Q3 to Q4, 2026, volunteer firms test parallel submissions using old templates and new data models. Pilot participants will get the opportunity to influence design, but need the resources to run these pilot programs. Feedback informs the 2027-2028 rollout, which is the current assumption.
And just to touch on this unified data submissions to the regulator, Greg, how far off, say, we are from this overall picture?
Thanks, Priyank. So we think the realistic timeline looks like it's 5 to 7 years for full implementation across the UK banking sector. The BOE's insurer program took over 3 years, and that was a smaller and a more homogeneous population of firms. For banks, Q2 consultations will propose the framework with volunteer pilots in H2 26. We assume the rules will be finalized in 27-28 and a phased rollout, probably 28-29 for large banks and extending beyond this for small institutions. Yeah.
And with this simplification program, they brought in easier, in your opinion, or just more transparent?
So again, a mixed answer. Probably more transparent, but not easier initially. It does represent a significant process shift, and also requires budget to deliver and retrain. This is both on the business and technology side. So in the short term, we think this is actually going to be hard. Implementing change usually isn't an easy thing to do. Firms running parallel submissions invest heavily in infrastructure, retrain teams, and compliance costs will rise before they fall. However, looking further out, it will be an easier operational concern. But basically invest in the automation and you can submit with fewer manual reconciliations is is how we are thinking about this. So Priyank, I'm going to turn the cheers. I'm going to turn the spotlight onto you and talk to you about COREP and FINREP. So how do you think these 2026 developments converge when it comes to COREP and to FINREP reporting?
So we spoke a bit about changes in the standardized credit risk, operational risk, and output floor. So the PRA smarter regulatory framework will streamline FINREP templates. The way you'll do this is by removing overlaps with COREP and aligning definitions with Basel 3.1 concepts. For example, exposure classes and capital components. So we're expecting cleaner cross-template consistency and fewer redundant fields. As in addition, UK regulators are pushing a lot for shorter submission deadlines and tighter reconciliation between COREP, FINREP, and internal MI to ensure that Basel 3.1 compliance is timely and accurate. So some of the changes will be, as I mentioned, FINREP fields such as separate corporate exposure tables when COREP captures these under the standardized credit risk exposure classes. When we talk about aligning definitions, making sure that FINREP uses the same exposure class categories definition as COREP, for example, for corporate, retail, specialized lending, and also simplify capital reporting by referencing COREP's Basel 3.1 capital components instead of CET181, instead of duplicating them in FINREP. So the overall net result is instead of reporting corporate loans, for example, in two different templates with slightly different definitions, firms will report once using Basel 3.1 exposure classes, improving consistency and reducing the reconciliation issue. One of the key things is Basel 3.1 has granular requirements, like collateral type, maturity buckets, operational risk indicators. Therefore, firms will need robust data lineage and automated validation frameworks to link granular data to trace it back to their source data and COREP and FINREP submissions. So if we look at collateral type, the revised standardized credit risk framework introduces more granular collateral classifications like financial collateral, real estate, receivables, with specific haircuts and eligibility criteria. So why does this matter for data lineage? Firms must trace collateral data from their source systems, so their origination, treasury, through to COREP templates to ensure correct mapping of Basel exposure classes and risk rates. Validation is also required, so automated checks should confirm that collateral type aligns with eligibility rules and that haircuts applied match regulatory specifications. In the same way, you've got maturity buckets, so exposure reporting now requires detailed maturity breakdowns, less than 3 months, 2 to 12 months, etc., for credit risk and liquidity risk. So in the same way, there's a data lineage sourcing back to the original, and also validation rules to verify that the maturity buckets reconcile with original contract data, and that any adjustments like amortization schedules are correctly applied. Supervisors are increasingly looking at data governance and not just the numbers before. So
there's lots to do. Where do you think firms will be struggling most? The data granularity or the governance around reported figures?
So both of these are things, right? But data granularity is the technical challenge, while governance is the strategic challenge. The regulators and regulators expect firms to excel at both. So success will most likely depend on early data mapping, gap analysis, strengthening the control framework to handle reporting complexities, and also embedding governance into the processes, not treating it as a one-off exercise.
And keeping with FINREP and COREP, is FINREP catching up to COREP in terms of data expectations?
So I would say FinRep is no longer purely accounting driven. Increasingly supports using stress testing and risk analysis. So it requires a richer data set and aligns with potential objectives. The PRA's future banking data program and the EBA's data point model updates sort of harmonizing taxonomy, making FinRep and program instruction similar central data architecture. So there'll be a semantic glossary and a version control data point for the FinRep and program. Great. Just moving to the last part of the talk. So if you had to summarize the 2026 priorities for reporting needs, what would they be?
Thank you, Priyank. I would treat 2026 as an execution and testing year, full Basel 3.1 readiness by Q4. Align Basel 3.1 changes with other live reporting frameworks, leverage stress testing and ESG disclosures, prioritize data alignment across COREP, FinRep, and RF for EU groups, strengthen auditability and documentation ahead of the PRA's final 2027 expectations, build and automate rules-based reporting tools now to handle acceleration of future regulatory submissions. So, Priyank, can I just give you a follow-up here? Looking from a market-wide perspective, which regulatory initiatives outside of Basel 3.1 do you think will shape the UK firms most this year?
That's a good question. So I would say continued work on ESG, climate, expansion of the Pillar 3 ESG templates, and integrations of FinRep and COREP, driving the sectoral and environmental data requirements. That would be the key one. Further output from the BOE's data collection transformation pilots, so beyond the template rationalization, expect continuous data collection and integrated dashboards, and potential disclosure requirements evolving under the smarter regulation, capturing customer outcomes, claims data, and vulnerable customer metrics. This reflects the FCA's customer consumer duty. And firms that are proactive on data quality and model governance will find themselves better positioned for upcoming frameworks like IIDF and digital data.
Thank you, Priyank.
Thanks, man. So just to close off with some thoughts and next steps, as we wrap up in today's session, just bring together what we've covered. So 2026 isn't just another year of regulatory updates, represents the final runway before one of the most significant transformations in financial services since the post-2008 reforms. Basel 3.1 does go live on 1st of January 2027. The deadline is fixed. So what you do in the next 12 months will determine whether the institution begins 2027 with confidence or faces last-minute firefighting. We discussed how Basel 3.1 will fundamentally shape COREP reporting through standardized credit risk weights and standardized measurement approach for operational risk and output floor calculations, leverage ratio templates as well, and also some of the shadow submissions in Q3 and Q4 towards the end of this year. But Basel 3.1 doesn't exist in isolation. It's converging with the UK's smarter regulatory framework, which is streamlining requirements for small institutions, stronger template ratio as well. The BOE's transforming data collection program is moving towards unified submissions, as we discussed. That will fundamentally change how you interact with regulators. Submit once, use everywhere. And it launches this year, and early participants will shape the future of regulatory reporting. Greg, anything you want to add?
Thanks, Priyank. Pretty an exciting year. The message from the regulators is quite clear. They are looking for timelier and higher quality data with complete audit trails. This is not about ticking compliance boxes. It's about building an infrastructure that can adapt as regulation evolves. Firms that invest now in data lineage, automated validation, and integrated reporting platforms will find themselves ahead of the curve, not just for 27, but for RF style frameworks and digital reg reporting initiatives coming down the pipeline in the future. So what should you prioritize in the months ahead? First, use Q1 and Q2 to complete your data gap analysis and strengthen your governance frameworks. Map your granular data points to the new Basel 3.1 taxonomy. Build your reconciliations and test your calculation engines. Second, prepare for parallel runs in H2. This is your dress rehearsal, and you should treat it like a go live. Third, don't work in silos. Basel 3.1 leverage ratio changes, FinRep updates, and data transformation initiatives should be part of a coordinated program rather than disconnected projects. Priyank, any final thoughts?
I would just say, final thought, to remember that proportionality is important. So if you're a smaller institution eligible for the SDD2 regime, you have until 31st March 2026 to notify the PRA and benefit from the simplified requirements. So that's a genuine opportunity to reduce complexity and cost. But acting now is fightable. 2026 is your execution year. Frameworks are set, timelines confirmed, and the UK regulators' expectations are clear. So the firms that, as mentioned, the firms that succeed are those that recognise it's not just a compliance challenge, it's a strategic opportunity to build a smarter, more resilient capabilities that will serve well beyond January 2027.
Thank you, Priyank, and thank you all for joining today's session. We hope you found these insights valuable and actionable as you navigate the year ahead. If you'd like to learn more about Suade, about how Suade is helping institutions build smarter regulatory solutions and prepare for these changes, visit us at www.suade.org to stay updated on upcoming events, regulatory developments, and industry insights. Make sure to give us a follow on LinkedIn. We look forward to connecting with you again soon and wish you every success in 2026. Thank you and goodbye.
Thank you.